Yeah, any profits or gains arising from the transfer of capital asset will be taxed under the head of capital gains. That's what we have discussed in the previous class. And we also discussed what is capital asset, right? And we haven't discussed fully about the transfer, what is transfer, what is not transfer, right? Because that is not required for the directly required for the question, so we haven't discussed yet. And we have discussed capital asset converted into stock in trade. We have discussed concept about that, and also we have discussed section 111A, section 112, section 112A, mainly about this. All right, so let's see what we have discussed. So capital asset can be converted into, capital asset can be classified into two types. One is short-term capital asset, another one is long-term capital asset. This is just an overview of what we have discussed yesterday, so I'll be going a little bit fast. And so short-term capital asset or long-term capital asset. So 36, 24, 12 months. If it is a listed equity shares or zero coupon bond, units of equity oriented funds, and if it is more than 12 months, it is a long-term capital asset. If it is less than 12 months, it is a short-term capital asset. And 24 months is for the immovable properties, unlisted equity shares. And if it is more than 24 months, it is long-term. Less than 24 months, it is short-term. Any other assets, 36 months. If it is more than 36 months, long-term. If it is less than 36 months, short-term. We have discussed there are three conditions to be satisfied, then only we will tax under the capital gains head. One is condition 1, it must be capital asset. There must be a capital asset. It should fall under the definition of capital asset. We have discussed what excludes from the capital asset. We have discussed, stock in trade, raw material used for business or profession, and personal effects, movable personal effects, and zero coupon bond, special bearer bonds. And we have discussed about the gold deposit schemes. So for these things are specifically excluded from the capital asset. We also discussed rural agriculture land excluded from the definition of capital asset. So that is not a capital asset. We have also done a question about it, we have discussed the limits, right? Up to 2 kilometers, 10,000 population, that one. Now, so it should be a capital asset, and then there should be a transfer should have happened, and then transfer should have happened in the previous year. Then it will come under the head of capital gains. And we discussed the format which will come under section 48, computation of capital gain. You should always start with the FVC, full value consideration, minus expenses on transfer. Then you will get the net sale consideration, minus indexed cost acquisition, minus indexed cost of improvement. You will get the long-term capital gains or long-term capital loss. Remember that we will do indexation only for the long term, and we don't do any indexation for the short term. And we were discussing about the one concept called conversion of capital asset into stock in trade. So whenever you are converting your capital asset into your stock in trade, there are two heads involved, capital gains involved in this, PGBP involved in this, right? So it is here we need to understand, and we need to remember the important part, the year of taxability. When do we tax? We will tax only in the year of sale of such capital asset, right? So we will tax it only in the year of sale of such capital asset. Okay. And if any asset is acquired before 1/4/2001, then we will take FMV on 1/4/2001. FMV means fair market value of 1/4/2001 is the cost of such asset, right? And we have discussed, I guess we have done one question about it, like conversion of capital asset, and then we were doing one more question, but at the end we ended the class. Now we'll complete that question. And one of the very, very important thing, right? Section 111A will come under the short-term capital gains or short-term capital gains, and then that is 15% rate. And if it is a long-term capital gains, there are only two sections, 112A and 112. These are special rates. Okay, so 112 we will charge 20%, and one of the important in every question we need to check is section 112A, right? And if it is a long term capital gains, we will exempt up to 1 lakh. And 112A, when it is applicable, so for that they should satisfy all these conditions. So if the transfer is happening after 1/4/2018, and if it is a long term capital asset, and that asset is listed equity shares or units of equity oriented funds and business trust, and security transaction is paid both on buy and sell, if all these conditions satisfy, okay, if all these conditions satisfy, then section 102A, 112A is applicable. This is just to check the applicability only. So once you confirm that 112A is applicable, then you need to check immediately this part, right? So we need to worry about the cost of acquisition. So what would be the cost of acquisition if section 112A is applicable? So we need to check, is the date of acquisition is after 31/1/2018, then you just take actual cost, no problem. If the date of acquisition of that particular asset is before 31/1/2018, then again you need to check these things. So actual cost of the asset and the least of the following: FMV on 31/1/2018, let's just say actual cost of the asset is 100, fair market value on 31/1/2018 is 120, then full value consideration, that means whatever the price we are selling, which is 80, then we will take whichever is lower, and then again we will take whichever is higher. I'm going a little bit fast because we have discussed all this yesterday. Now these things, if 112A is applicable, no indexation benefit is applicable, you cannot claim the rebate under section 87A, and no chapter 6A deductions. And this part I have told you, I will explain that when we are doing questions. This is what we have discussed. Okay, now continuing, and also we have discussed one more thing about the 54EC exemption. So 54EC exemption is applicable if it is the capital asset is land and building or both, and whenever you are investing in this NHIA or rural electrification bonds, REC bonds, maximum exemption you can claim is 50 lakhs, and you have to invest in within 6 months from the date of transfer of such particular asset, and lock-in period is 5 years. So these are the things which we have discussed yesterday, and while doing one question we have abruptly ended the class. Let's continue that class now, that question now. And I want you to, after completing this, I want you to do all the problems whatever is there in your module. That would be pretty much easy, right? And if you have a doubt, you can text in the group about that doubts. Okay, let's see. So yesterday we have completed the first question, we have completed the second question which involves the 112A concept, and then first question is about the conversion of capital asset into stock in trade, that also we have done. Now the third question, which involves conversion of capital asset into stock in trade, and also 54EC exemption, which we already discussed. Now we will do that based on these concepts, like we will complete this question. Okay. Harsha purchased the land at a cost of 45 lakhs. Just give me a second, guys. Yeah, so Harsha purchased the land at a cost of 45 lakhs in the financial year 2007 and 8. Held same as her capital asset till 31st March 2017. She started her real estate business on 1st April 2017 and converted the said land into stock in trade for her business on the said date, when the fair market value on of the land was 225 lakhs. So FMV on the date of conversion, FMV on the date of conversion is equal to 225 lakhs. See, why do we require this? We have discussed this yesterday. while we discussing about the conversion of capital asset into stock in trade, if you see, two heads are involved, right? One is capital gains involved in this, another one is PGBP is involved. Now FVC, we know the section 48 format, computation of capital gains. What is the format? FVC minus expenses on transfer, then you will get the net sale consideration, then minus indexed cost of acquisition, then minus indexed cost of improvement. There you will get the answer, right? So the same thing here also. But what we consider as FVC, we are not selling to anybody, we are just converting our capital asset into stock in trade. Stock in trade means our business, right? We are converting, let's just say you are like in our present question, what did they do? Our land is a capital asset. We converted into real estate business, like we started a real estate business. So the same land turned into stock in trade, the same capital asset turned into stock in trade. Now we are just converting, we are just converting capital asset into stock in trade. We are not selling to anybody, so there is no actual sale value. So that's why what do we do is, on the date of conversion, what would be the market value? That market value we will consider as full value consideration. So from that you will deduct the if there is any expenses on transfer, then same remaining the format. So it is absolutely important to know what is the fair market value on the date of conversion. Okay, now coming back to our question. So fair market value on the date of conversion is 225 lakhs. Okay, she constructed 15 flats of equal size, quality, dimension. Cost of construction of each flat is 15 lakhs. Construction was completed in January 2019. She sold 10 flats at 40 lakhs per flat in 20th March 2019. See, after converting into business, she sold the flats. The land she converted into the flats, she constructed flats and then she sold it. This is business. This will come under PGBP. It won't come under the capital gains. And then remaining 5 flats were held in stock as 31st March 2019. And then again she invested 50 lakhs in bonds issued by NHAI and 50 lakhs in the REC. They are asking you to compute the capital gains and business income in the hands of Harsha. Okay, and assessment year is 2019 and 20. Now let's break this question and try to understand whatever is happening. And yesterday I told you, whenever you are solving the question, what are the steps you need to follow? First, decide what is the capital asset involved in the question. Next, decide what is the period of holding in the question. So you can figure it out based on the period of holding. You can decide whether it is a long term or whether it is a short term. Then check whether section 112A is applicable. This is very important, right? We have discussed all the conditions and everything, right? So we have to check whether section 112A is applicable. Anyway, section 112A is not applicable in this question because we are not talking about any listed equity shares or zero coupon bonds or anything. So this is not applicable. Now let's do this question. I will write this question as if it is an exam. How do I solve it? In the same way I will solve this particular question. Okay. Now what is the capital asset in this question, involved in this question? I already sent you the PDF in the group previously. Capital asset involved in this question is land, right? Then we need to check the period of holding. Period of holding. If you follow a particular format, then the question wouldn't be difficult. Okay, let's see the period of holding. So Harsha purchased the land for 45 lakhs in the financial year 2007 and 8. Okay, and until March 2017, until 31st March 2017, he did not transfer it or anything. So let's see. So the period of holding is 2007 and 8, 2007 and 8 to 1/4/2017. This is the date where he converted into stock in trade. Until that he did not do anything. So now for land I need to check which one is applicable? 12, 24, 36. Which month, which number I have to take? Anybody? I need to take 12 or 24 or 36?
24.
24, because immovable properties 24 months. Very good. So we'll take 24 months. Obviously it is greater than 24 months. So then we have decided it is a long-term capital asset. So when it is a long-term capital asset, only two sections are there. What are those sections? Section
2A.
112A and 112. Obviously 112 is not applicable, so 112 is applicable for this. Okay, so under 112A 10%, under 112 20%. So this is all. We can figure it out by reading this part. Okay, then let's start the computation. See, whenever this question is involved, conversion of capital asset, we have two things. One is capital gains head, another one is PGBP head. First complete the capital gains head, then we'll go to the PGBP head. Computation of capital gains. The format is given under section 48. Okay, first we have to take full value consideration. Full value consideration. Okay. What is full value consideration? We will take FMV on the date of conversion. Yes, 225 lakhs. FMV on the date of conversion. Now we need to check, is there any expenses on transfer? Expenses on transfer. They did not give anything. So then whatever you get is called net sale consideration. Net sale consideration. Then you have to do indexed cost of acquisition minus indexed cost of acquisition. Now let's see. Indexed cost of acquisition, we know what the formula is. Cost of acquisition into year of transfer, here year of conversion. Year of conversion divided by year of acquisition. Okay, now cost of acquisition, let's come back to the question. Here they mention we bought it for 45 lakhs. Okay, and then when did we buy it? We bought it on 2007 and 8. So in 2007 and 8 it is 129. Okay, 2007 and 8 it is 129. This is year of acquisition. Then year of conversion, we converted when? We converted, she started real estate business on 1st April 2017. So she converted in 17 and 18. This is year of conversion. So let's convert from 2007 and 8 to 17 and 18. So cost of acquisition is 45 lakhs into year of conversion is 272 divided by 129. Guys, it's better if you are also doing. If you are just listening, I'm not sure how much you will learn. You already seen the question, you also do along with me. Then 45 into 272 divided by 129. So I got around 94.88. So I will take 94.88 as the indexed cost of acquisition. Okay, then I'm pretty much sure I've read the entire question just now. They did not tell anything about the improvement. So indexed cost of improvement is 0. Then I will get long-term capital gains. So 225 minus 94.88, which will be 130.12. Okay, so this is 130.12. Okay, next part. Okay, next part, that they told that she invested 50 lakhs in bonds issued by National Highway Authority of India on 31st March 2019 and another 50 lakhs in the bonds of Rural Electrification Corporation Limited in April 2019. Okay, let's come and see 54 EC whether all conditions are satisfied or not. So in 54 EC, the exemption part we have discussed. First of all, the capital asset should be whatever you are transferring should be land or building or both. In our question it is land. Yes, of course we are getting long term capital gains. Yes, we did buy the bonds, like we bought the NHIA bonds, we bought the REC bonds. Okay, and maximum exemption is 50 lakhs. So but what did we do in the question? In NHIA we bought 50, REC we bought 50. You cannot claim 100, you can claim only 50 lakhs. Okay, then we should buy this within 6 months from the date of transfer. Okay, now 6 months from the date of transfer. Here the doubt is, we have converted into stock in trade in 2017 and 18, right? Now when did we sell? When did we sell? She constructed 15 flats equal size in that land, and then they're given cost of construction. Construction was completed, and then she sold on 20th March 2019, right? 20th March 2019. That means what year? What is the previous year for this? 20th March 2019. She sold the flats. What is year? Can I say 18-19?
Yes, sir.
So 18-19 is the previous year, and then 19-20 is the assessment year. One of the important thing, yeah, sorry, what?
I was saying assessment year.
Yeah, good. So one of the important thing in this topic is, when do we tax? Year of taxation. So in conversion of capital asset into stock in trade, year of taxation is when this stock in trade gets sold, in the year of sale. Yes, we have converted the capital asset into stock in trade when 17 and 18 only. So this is the previous year we have converted, right? So normally when do you should charge? In 18 and 19 is the assessment year. So this is the year you should tax it, right? So that's what we have discussed in the basics, right? So what did we discuss in the basics? So if the capital asset is transferred in the previous year, obviously in the assessment year it will be taxed. But this is one of the exception, right? So it won't be taxed like this. It will be taxed only in the year of sale. Year of sale is 18 and 19. So this will be taken as previous year, and then 19 and 20 will be taken as assessment year, right? Now what is the condition here in the 54 EC exemption? They mentioned that from the date of transfer within 6 months you should have bought the bonds. Now from the date of transfer, so here date of transfer means like we will take from on which date you sold the stock in trade. So here we have sold the stock in trade on 20th March 2019. Okay, so within 6 months. Now tell me, did we buy within 6 months or not? So we sold it on 20th March 2019, and we have bought the on 31st March 2019 only we bought. So that means it is satisfied, right? Within 6 months from the date of transfer we bought it. Again another one we bought in April 2019. This is also within 6 months only. So that's why we can claim this exemption. Okay, now coming back to our answer, minus 54 EC exemption, right? So minus 54 EC exemption, EC exemption 50 lakhs. Okay, but normally this is the way to do it, but there is a simple small thing. What is the rule here? What is the rule in the conversion of capital asset into stock in trade? Whenever you sell it, then only you need to tax. In the year of sale only you need to tax. But if you observe in the question, whatever the land we have transferred, right, we have divided that into 15 flats. Okay, we have divided that into 15 flats, equal size, equal quality, equal dimension. Okay, and then obviously for each flat we have spent the money 15 lakhs. This anyway will come under PGBP because it is business related. The only thing I want you to observe is here, the remaining 5 flats were held is in stock in trade. Okay, because only 10 flats were sold, and according to our logic, right, now whatever the LTCG we got, right, this is for the entire land. This is for the entire land. The same land only they have converted into 15 flats, right? So according to our logic, we should tax only in the year of sale. But the total total 15 flats did not get sold. So that's why we will do proportionate basis, right? So this LTCG is related to the 15 flats. Okay, but only 10 flats got sold. So we should tax 10 by 15. Okay, so if you do 130.12 into 10 by 15, you will get 86.74, or you can round up to 75. So it will be, LTCG will be 86.75. From that you are going to deduct 50 lakhs exemption. Okay, then minus 50, you're gonna get 36.75 lakhs as the total long-term capital gain. So this is what we call it as, this is what we call it as long-term capital gains, or taxable long-term capital gains. After exemptions, we'll call it as taxable long-term capital gains. And then when we are doing this we are doing, so the sale is happened in the previous year 18 and 19. So we will be taxing in 19 and 20, assessment year 19 and 20. Any doubt on this? Any doubt anywhere?
No, sir.
Okay, now this is the capital gains part. Now come to the PGBP part. In PGBP, so first we want sale value. We want sale value. If you see, total 10 flats are there. We sold 10 flats only into 40 lakhs. Each flat we sold at 40 lakhs. So that means we got 400 lakhs. Now minus cost of acquisition, like at what price, or like, sorry, actually before that, cost of construction, they are specifically given in the question. So we can deduct that 10 flats into 15 lakhs only. Okay, so it will be 150 lakhs. Okay, and minus cost of land. You see, the cost of land on the date of conversion here also we need to take. On FMV on the date of conversion only you need to take. So FMV on the date of conversion is 225 lakhs. So that is for 15 flats. So we're gonna take only for 10 flats. So 225 into 10 by 15, you're gonna get 150 lakhs. So remaining 150 lakhs is taxable under the PGBP, taxable under the head of PGBP. So this is the entire question. Any doubt in this question? We have done the Harsha question. Let me know any doubt. No doubt?
We have to deduct 300 from 400. So the answer must be 100 lakhs, I guess.
Sorry, I did not understand. 200?
So you have deducted
just a second. Oh, okay. Oh, okay. Okay, that is 100. Yeah, 100 lakhs. Yeah. Any other doubt?
No, sir.
So in revision, like, if you have to tell what is the cost of conversion of into capital asset, means what you should do. So there are two sections involved, two heads involved in this. So what is FVC will be taken? FVC will be taken as what?
FMV on the date of conversion.
FMV on the date of conversion will be taken as FVC. Under PGBP, the sale value will be there, and then minus the cost will be there, right? That cost also will be taken as same FMV on the date of conversion. That is one point we need to discuss, we need to remember. And another point, it will be year of taxability is equal to year of sale. This is very important one, right? Year of taxability is equal to year of sale. Okay, now before going to the next question, what is the next question is about? So here this is Mr. Vikram sold his old residential house. Mr. Vikram sold his old residential house for 25 lakhs. Long-term capital gains arising on the transfer of old house amounted to 8,70,000. So they only given how much long-term capital gains we are getting, which is 8,70,000. In December 2017, he purchased another residential house worth 4,50,000. The new house was however sold in May 2018 for 14 lakhs. Stamp duty of the value of the new house was 13 lakhs. What will be the amount of taxable capital gains in the hands of Mr. Vikram for this assessment year 18 and 19 and 19 and 20? Okay, I will read the question again, but before reading the question, let's discuss one more concept. Yeah, let's discuss one more concept and then continue this question. Just